Stocks are higher, bolstered by a strong July retail report and fresh jobs data. Both data sets easing some concerns about a slowing economy and labor market. And these new numbers, they come ahead of that first rate cut that we're expecting in the fall. So we want to talk about what a rate cut means for your portfolio. Joining me now, we've got Keith Buchanan, who is the Global Investments Senior Portfolio Manager here. Keith, great to see you once again, and thanks for hopping back on the program with us. So first, everyone's trying to figure out how they can best position their portfolio for that pathway of rate cutting here. How can they get ahead of the Fed's decision?
Well, thank you very much for having me. And we're doing the same work here at Global. We've actually been moving our clients away from the most favored Mag 7 larger cap names that have moved the most over the past 2 years in anticipation of some disruption. We felt like the market had become unbalanced. We started to see that disruption about a month ago as the market priced in a little more hawkishness, dovishness on the part of the Federal Reserve, more cuts through the end of the year. We saw that accelerate over the past week or so, and we injected into there some disruption around the Japanese yen, as well as just growth concerns about the U.S. in general. As that's occurred and bounced back over the past week or so, the market's had a really healthy resurgence back to levels where we were late last week when that disruption really started to take place. So we're cautious about the market going forward. We think there are still risks. We feel like the volatility that was introduced really accelerated over the past week, but also the rotation is still underway as we see earnings growth spreading out to the other 493 names. So we want to be broad and diverse in equities, like equities overall, but want to be balanced with growth and value going forward.
I mean, Keith, we're taking a look at some of the major averages here across the bottom of our screen, and we were a moment ago. Now we've got some other tickers that are flowing across. But, I mean, it seems like markets have tried to get back into rally mode following some of that early August volatility here. What is the key data that will continue to keep this rally intact in this near-term period of time ahead of that FOMC decision come September?
Sure, you saw it start to stabilize last week as we had jobless claims that came in and didn't confirm that the sky is falling and recessionary pressures were all around us. That concern pulled back some. You see the market start to stabilize and start to drift back hard to regain some of those losses from 2 weeks ago. So as we look towards next week, Jackson Hole's speech, of course, we'll get more rhetoric from Chairman Powell going forward into the mid-September Fed meeting, where the market's priced in almost certainty of a 25 basis point cut. But also the rhetoric around the cadence going forward would dictate a lot of the direction of the markets in the interim. So we're cautious, but positively looking towards the macroeconomic developments, as well as the rhetoric out of the Fed, which could tilt a little hawkish, but also deliver those cuts that the market's been anticipating for some years now.
Are there key sectors that could benefit from the economy remaining stable or stabilizing while at the same time knowing that the Fed is going to begin its cutting pathway, and ultimately that would spell out that they would see something in the data that signals that they should begin cutting, which points towards, okay, any type of recession risk or risk that there would not be an all-out soft landing? What sectors would stand to benefit even if there was that dichotomy taking place?
That's what we think is really important, the needle that the Fed has to thread over the next 2 weeks, where they have to communicate, and the market expecting a cut. How to communicate the cadence going forward is going to dictate whether the market expects a recessionary pressures and unemployment is going to continue to increase in a way that pressures economic growth going forward, or is it just pulling back because inflation is heading to a territory where it's under control? Is it a threat to real growth or not? And that threat bleeds into how the sectors will perform going forward. If it is a threat to real growth, as we saw on couple of weeks ago with the volatility increase, you saw utilities, some staples, the real estate, some of those groups that have that benefit from the rate environment continue to deteriorate, as well as growth declining, and those more stable, dividend producing equities and instruments across the board tend to outperform in that environment. So the rhetoric is important as to whether the bull market can continue, as well as which sectors will outperform and underperform as far as the expectations for real growth going forward for the rest of the year.
Keith, are you still in the 100 basis point cut over the course of this year, the back half of this year? And if so, how do you see that playing out? Are we seeing 50 points from your perspective at this next meeting? And then where would the rest of those 50 points come from?
We think that's fascinating at this point. And it actually has pulled back some from 125 to now the market's expecting 100 for the course of the year. We are skeptical of whether the Federal Reserve has enough wiggle room to cut each meeting and also an additional cut, whether it's a jumbo cut more than 25 basis points or a cut between meetings by the end of the year. We don't think the scenario economically justifies moving in such a dramatic manner. So we're skeptical of whether the market gets those 100 basis points of cuts between now and year end. We feel like 25 each meeting is a cadence that we expect and what they could communicate in September, which leaves us one cut shy where the market currently is. So there's some risk in the market understanding and appreciating that 25 basis points could potentially be the cadence going forward for the rest of the year, unless things deteriorate much more quickly from here on out. And that's just not in our consensus as we speak, and also not in the base case we have here at Global.
Keith Buchanan, who is the Global Investments Senior Portfolio Manager. Keith, great to see you once again. And thanks so much for hopping on Yahoo Finance.
Thank you.